Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates. Coming to you 9 a.m. Eastern Time every Monday morning. Usually try to do it live every other week. Just kind of connect with you out in the Bowtie Nation there, answer some of your questions. All you out there in the nation know this is my favorite part of the week. Really just getting back to you and getting your questions answered. Got a big week this week. Obviously, the bear market rally has been confirmed. We are down almost to those June lows, and there's no sign of stopping the market. So I wanted to share kind of my strategy, what I'm looking for, why I think the market will can continue to fall, why I think stocks will continue to fall in this 2022 stock market crash, and two specific points that I'm watching for that are going to indicate that we can at least look forward to a next bull market, right? 2 points that I think you can watch for to know when to buy stocks, as well as my specific strategy that I'm using. Great to see everyone there in the chat. You see Ambrose there from New York, Matthew, Deep Salmon. Good to see you there. Let me know where you're coming to from in the Bowtie Nation there. We're actually in our new home in Tampa, which is greeting us after about 2 weeks of living here with a hurricane coming up. So Hurricane Ian heading for Florida in the next couple of days. All I can say about that is, if you're down here on the Gulf Coast, just be safe, stay inside, and ride this thing out. We're keeping up to date with the news to see exactly where it's going to strike, but wherever it hits, just my prayers go out for you, and stay inside and stay safe, like I said. But I do want to get to this week's topic because, again, with a weaker economy on the horizon, something we've been talking about over the last couple of months, there's just no sign that this crash is over, and unless you know what to look for, really, right? So I'm going to revisit my strategy that we've talked about before on the channel, why the market is going to be likely to fall further, and what to watch for to know when you can start buying stocks. Before we do that, I do want to show you. Evidently, Reddit has been a big thing over the last couple of years. I didn't know, right? It's all the subreddits with stock ideas and stock suggestions and the meme stocks. I didn't want another social media platform. I didn't understand it, but it is just something that you can't ignore anymore, right? I was getting tired of Facebook limiting our posts. I was getting tired of YouTube only showing you out there in the community, out there in the Bowtie Nation, the videos they want you to see. So you can never really have a true free and engaged community without that kind of sharing and without that kind of conversation. So we started the Let's Talk Money channel Reddit subreddit just last week. Already over 500 members in there and some great conversations. So I'm going to leave a link in the description below, as well as in the chat box there. Go ahead and click through and join the conversation there over in Reddit. I got to tell you, I'm surprised. I just started using it, and it is a lot of fun for the kind of conversations you can get going, and you see all of them, right? You don't have to wait till Facebook shows you what conversations they want you to see. So go ahead and click on over there with the link that I'll leave in the description or in the chat, or just go to the subreddit Let's Talk Money channel. But I do want to get today's topic because obviously it's something that everybody's been asking about. What is my strategy for buying stocks? When is the stock crash going to be over? We are now down 23% from the pullback in January, from the January peak of 4,800. It does look like we're going to fall further. Today's futures are down. And there's really no reason that stocks won't fall further. There could be some signs of relief rally this week, just on technical oversold conditions, and I'll get to that later in our weekly update. But there's really two key points that I'm watching for and reasons why the stock market will continue to fall further. And we're going to talk about those. So I first want to outline why I think stocks are going to keep on falling, the two specific signals that I'm watching for, and then that strategy for when and how to invest in stocks. By its own admission, the Fed just raised rates again for the third consecutive time at 0.75%, the third straight meeting raising rates by 0.75%, which is the highest it's raised rates since 1994, right? So three consecutive meetings in a row, it's raised rates by the most in 30 years. It's already raised rates to a 3.25% range, up to 3.25, 3 to 3 and a quarter. The market expects it to go another 1.5%. Okay, so imagine that. Over the past 3 meetings, they've raised rates by 2.25%. The market expects them to go up another 1.5%. And just think of what that does to the economy, what that does to the stocks and stock markets. Okay. By its own admission, the Fed is now slowly increasing its rate outlook. The Fed now expects to raise rates by at least another 1% over the next year. Different Fed members, Chair Powell has slowly started to talk about a recession and the economic pain that it's going to cause just to bring inflation down, and the jobs he wants to destroy. Right. And frankly, there is no other way that we bring inflation down than to weaken the jobs market. Okay, the Fed actually says that it wants to bring the jobs market, or expects to bring the jobs market unemployment rate up to 4.4%. That's from 3.7% right now. Okay, so just that 0.7% of extra unemployment on the jobs market is going to be 1.2 million people unemployed. Okay, that's what the Fed wants to do, and that's what it has to do. Honestly, again, until you get a weaker jobs market, until you get weaker consumer spending and consumer sentiment, which drives this economy. 70% of the economy is from consumer spending, from consumers getting out there and spending those employment checks, right? Until you get a weaker jobs market and you don't have that, then you're going to have higher inflation. The Fed knows that, and the Fed knows what it has to do and what it's going to do. So again, that's at least 1.5 million jobs that are going to be out over the next year because of these Fed rate increases. Another big point that I'm watching is, and this is one of the big ones, this is one of the things that I think is going to send stocks lower, and is one of the signals you need to watch for to know, okay, the market is working through all the worst news. Okay, once we get all the worst news baked into stocks, then there's nothing left but to go upwards and hit that next bull market. But this is one of the signals: the utility bills this winter. Just here in the United States, utility bills, or utility costs, so the cost of natural gas, the cost that utility companies have to pay, is averaging 30% higher than last year. Okay. And now, of course, not all utility companies are going to be able to pass on all those costs to consumers this winter, but a large portion of them will. All of them will, to some extent, increase utility bills. So we're looking at utility bills this winter across the United States. They're going to be up to 20, 25, and 30% higher than last year. What do you think that is going to do to consumer sentiment? What do you think that is going to do to consumer spending? And again, that's 3/4. That's 70% of the economy right there in consumer spending. So I'm waiting for the market, the economy, everyone to start talking about this, how high utility bills are going to be, or are, during the winter months, and how that is going to destroy the economy, destroy consumers, because consumers aren't going to be there to support the economy like they have been. We've already been seeing a lot of negative news about the economy. The economy just went through 2 quarters of declining GDP, but the consumer has been strong. The households have saved up a lot of money through the pandemic, still have a lot of savings. That savings is running out right now and is going to be destroyed during the winter when those utility bills hit. So that's what I'm watching for, okay? As we get into November, December, those utility bills start creeping up and people realize, oh shit, I don't have any more money. I can't pay my utility bills. How am I going to go out and spend on the discretionary stuff and other things? So people are going to start pulling back on their spending. Businesses are going to start realizing that, and are going to start realizing, okay, this recession is here, it's coming, and it's going to be a lot worse than we thought. That's the first signal, and it's really going to be the first shock to stocks, okay? When the market realizes that and starts baking that into stocks are going to have to fall a lot further. And we're going to get into about how much that's going to fall and where I'm buying at that point. Another thing, it's just as bad over in Europe. We talked about this last week with the European energy crisis. Those utility bills are even higher. Some utility costs to utility companies over there in Europe have doubled and tripled over the past year. And they are starting to nationalize energy companies, right? Germany just had to nationalize its largest energy company, Uniper, and so take that over, save it, give that a bailout to keep it from going under. Russia is cutting off natural gas and other pipelines and things like that, and Europe is in for it. Is a historic crisis in energy like we've never seen. So That's really going to be the first signal and the first shock to stocks is when the market realizes consumers globally are not going to be there to save the economy. Another one I'm looking at is really just the fact that the market and investors seem to be hoping, ridiculously hoping that there is no recession, right? That the Fed can somehow engineer a soft landing, even though the Fed's track record has been nilch zero for being able to engineer a soft landing. Basically raising rates to bring down inflation, but not cause a recession. That's not going to happen, folks. We've already had 2 quarters of negative GDP growth, and we are not even into the worst of the economic effects of these interest rates. So, the only way for inflation to come down, again, is for that higher employment, 1.5 million jobs to be lost, and the market needs to realize that. Okay, so until you, as you keep seeing news articles, analysis that talk about hope for a mild recession or no recession at all, then the worst won't be baked into stocks. Until investors, the market, until all this analysis starts reflecting the idea that yes, there is going to be a recession. There is no doubt about that. The only question is how bad it will get. Okay. That's the point where the worst is going to be baked into stocks. Okay, that's another shock that's going to have to happen. It's going to bring stocks down. Okay, so those are really the 2 signals that I'm watching for to kind of get a feel for how much of the worst possible scenario has been baked into stocks. Now, all you out there in the nation know I like to use kind of a 3-level approach to investing. And that's basically just picking levels in the S&P 500, and we're going to talk through this, where I want to start deploying my cash. Right now, I have about 30% of my portfolio in cash. Some other safe investments like I-bonds, guaranteed, money market and savings bonds, things like that. Things that I can liquidate, things that will not lose value as rates increase, like bonds, as well as some short-term bonds that don't lose quite as much of their value, when interest rates go up as well. All right, and if you're looking for things like that, we've talked about I-bonds before on the channel. We've talked about, the BSV, the Vanguard Short-Term Bond Fund. That's the ticker BSV. There, it does lose some value as rates go up because they are corporate bonds, but not quite as much, right? They don't lose nearly as much as some of those longer-term bonds. You've also got the TLT, which is the Treasury bonds, as well as some of those other government bond funds that I would look at for that cash side of your portfolio. But again, there is nothing wrong with holding cash. It is going to give you that ammunition to deploy and to use at these lower prices that we're going to see here over the next few months. So what I want to do is, again, I want to pick 3 levels in the S&P 500 where I want to start deploying that cash. And one, this is just going to give you the best of both worlds when you're investing, as well as holding some money holding some money back for just in case stocks do go down further. So my 3 levels here are really 3,500, 3,200, 3,150, somewhere around there, and 3,000. Okay. And what I'm watching for is, when the stock market, when the S&P 500 levels get to that point, I'll deploy maybe a third of my cash, right? So say I have $100,000 in cash in my portfolio. When the stock market falls to 3,500, I'm going to use about 30,000, 33,000 of that to invest in my stocks, my favorite stocks, the stocks already in my portfolio. Peter Lynch said a great quote by Peter Lynch said, sometimes the best stocks to buy are the ones already in your portfolio. I think we spend so much time looking for new stocks to buy, and people get portfolios of 30 and 50 stocks that you don't realize, some of the best ones out there are the ones you already believe in because you already own them. So just look in your portfolio, the best stocks, the ones you want to hold for 10 and 15 years, give them time for that market rally and that next bull market to occur. Those are the ones you want to double down on and keep investing in. So yeah, 3,500 I'm looking for. That's going to be about 27% from the January peak. And why I picked that is because it's a new low for the year, right? 4,800 was the peak in January. We hit 3636 there in June at the June low. And then, as the market keeps falling, then I expect it'll hit 3,500 for 27% down from the peak in January. And that's about the average for bear markets, 29% over the last 50 years. Bear markets have averaged right around 27 to 30% down on average. So, at that point, I don't think the stocks are done falling. I do think they can continue to fall, especially if we haven't hit those 2 signals that I talked about, those utility bills and the recession. Okay. But at that point, I do want to start putting some cash back to work. Okay, I don't want to wait until the absolute bottom of the stock market, because you'll never find that. Okay, you'll never time the market perfectly, and you'll never find that exact bottom. Okay, so the worst thing you can do is just keep waiting, and let stocks go all the way back up, and never be fully invested, or never be invested to the point you want it to. So at that point, 3,500, I'll deploy a third of my cash and really put that money to work, start it working for me. But I still have quite a bit of cash left over to take advantage of those lower prices if they come. At that point, if stocks do hit the 3,200 to 3,150 mark, that's on the S&P 500. Again, that's about 33% from the peak. Okay, so I've saved myself another maybe 6-7% downside protection on the rest of my cash. I'm going to deploy another third of my cash. So that would be, in that example with $100,000 cash, that would be another $30,000 of that. I would then invest in my favorite stocks, in the stocks that I really like. And again, that's right around maybe 3,150. That'd be about 35% down from January's peak. That'd be right at where the market stopped falling in the 2020 pandemic crash, right? In February, March of 2020, during the pandemic, the stock market crashed 35%. Of course, that was in a much shorter time frame. That was only 23 days that the market crashed 35%. So very quickly. I don't actually consider that a stock market crash, because that was obviously extenuating circumstances with the pandemic, that kind of thing. When I measure crashes, I usually measure, the big ones like 2008, 2000, things like that. But so 35% was the 2020 crash, and that's kind of what I'm aiming for that second level down. Okay, so that'd be about 3,150 on the S&P 500. Again, I'll start deploying that other third of my cash. Finally, if the S&P 500 falls to 3,000, okay, that would be 37% down from the peak. I would invest the rest of my cash. So at that point, at 3,000, I would be fully invested with my cash into those favorite stocks and holding on for the long term. Again, I didn't necessarily just pull those numbers out of my ass. The 3,500 again is right around that bear market average, the stock market crash average. The 3,150 is right around the 35% that the stocks fell in 2020, and then the 3,000 more importantly is about 15 times my. Is about 15 times what I'm expecting for price to earnings. Okay, so if we look here, I want to show you some charts here that I'm using to kind of forecast where stocks are going, what that final level that I want to be invested at. Okay, this is FactSet. Okay, all you out there in the nation know one of my favorite resources for stock market information. So FactSet surveys analysts, it watches the earnings coming out, and it really gives you some great free information. You just go to Google, type in FactSet Earnings Insight. That's FACT SET Earnings Insight, and you're going to get a free weekly resource there. Now, what you're looking at here is the S&P 500 calendar year-end bottom up earnings per share actuals and estimates, right? So here in the dark blue are the earnings per share of all the companies in the S&P 500, right? So if you took all the S&P 500 companies, the largest 500 companies in the United States, added up their earnings each year, this is what you'd get. In 2021, all those companies, those 500 companies, had $208.49 in earnings, okay? This year, 2022, those companies are expected by analysts to report $226 in earnings. Now, okay, so I'm taking that as pretty much a given. We're almost into the third quarter earnings reports. Companies generally always beat earnings expectations. So this is pretty well $226 is probably pretty darn close to what companies are going to report as far as earnings in this year. Now, that's unless the fourth quarter, so unless the last quarter of the year, so this October, November, December period, unless that just completely falls apart, everybody just comes to a standstill and doesn't spend, we will be right around that $226 per share. Now, what my problem with this and why I think this is just ridiculous here is if you look at next year's earnings expectations right here, for 2023, analysts on Wall Street still expect the companies in the S&P 500, the stock market, to report $243 in earnings, okay, which should be I think it's about 5%. I want to say about 5% above this year's estimate. So 243 divided by 226, That's be about seven. Analysts expect earnings for S&P 500 companies to grow by 7.5%. And there's just no way in hell that it does that with a recession. Okay, they're delusional. Okay, if you look at, I got this data from Deloitte, right? This shows the earnings per share, the effects of, through inflation or through recessions and that kind of thing. The change year over year, change in earnings. So you got this line here, and this is the year-over-year change in earnings. And anytime we have a recession, these shaded areas, you see earnings just drops off a cliff, right? And that's obvious. Okay, if we have a recession, people aren't spending, business activity slows down, and you get a drop in earnings. That drop in earnings is generally between 10 to 20% on average. That's data back almost 100 years, back to 1948. In those recessions, we've had a 10 to 20% drop in corporate earnings. So I don't know how you expect, and again, of course, this is just because analysts and the market is holding out hope that we do not get a recession, that the Fed can engineer some kind of soft landing miraculously, but there's no way in hell we do that. We will have a recession, folks, especially, as I talked about, as those utility bills start hitting consumer spending, we are going to have a recession. As the Fed raises rates by at least another 1.5% to slow down inflation, there is going to be a recession, and we are not going to get to this $243 in corporate earnings. Okay, it's $226 this year. If we do, it's just some kind of back of the envelope math and say it's even a very light recession. Okay, if corporate earnings only go down 10%, so we times this by 0.9, that gives us $203 per share for corporate earnings. Okay. So my expectation is that we get some kind of a recession. It doesn't even have to be a big one. Just a mild recession is going to bring corporate earnings of the S&P 500 down to $200 per share. Okay. And now what I'm saying here is if we look at any kind of a price to earnings chart, okay, historical price to earnings. Again, this is a chart by FactSet. It's the PE ratio over the last 10 years. You can see in this darker blue dash, that is the 10-year average. 10-year average for PE ratios for stocks in the S&P 500 in the market has been just over 20. Okay, so 20 times has been the average price to earnings ratio. That's the price of the index, the price of the S&P 500 divided by the earnings of all those companies. Okay. Now, what I'm saying is if you look down here, 15, and if you go down, you go back even further, you go back 20, 30, 40 years, and that 15 level, 15 times price to earnings has always been a really good level to buy stocks. Okay, if you can get stocks at, when the market is down to 15 times price to earnings, then you're doing pretty well. You're going to have good gains, good returns in the years to come. And you look here, I mean, if you had bought here in, this is 2012, last time stocks were really at that 15 times price to earnings level. I mean, you had all these returns to speak of, in the years to come. So what I'm looking for, what I'm saying is, if you do invest at that 3,000 level, right? That 3,000 level, that final level that I'm watching for in the S&P 500, if I invest the rest of my cash and I'm fully invested at 3,000 when stocks are right around that, that 15 times price to earnings ratio, I'm fine with that. Even if stocks fall further, they could fall further. That's only 37% down from the peak. And we know the last two real recessions, the last two real stock market crashes in 2008, 2000 have been down 50%, right? So we'd have quite a bit more pain from 3,000 down lower to 50% off on the stock market. But I would be okay with that, right? Because I would know that I got in, at the right time at 3,000, even a little bit higher on some of these other two levels. And, my money is going to eventually work for me and provide those very good returns as the next bull market heads higher. So again, I'm not saying that you need to time the market perfectly. I'm not saying that you want to even try to time that bottom of the bear market and find that market low. You don't want to do that, okay? Because nobody knows where it's going to be. Nobody knows when stocks are going to head higher. So what you want to do instead is you want to make sure that you're holding back cash for different points in the market as the market moves lower. And then at different points in the market, you want to deploy that cash. You want to get it started working for you. Okay. So again, my levels for that are 3,500 3150 and about 3000. Okay, that's where I'm going to start making that money work for me. That way I know that I have money working for me, but I also have money set aside if the stock market falls even further. One of the best things about that is it keeps you from just stressing out about the market. Okay, I see too many investors heading to heading to their stock screens, heading to Yahoo Finance every single day, worrying, should I invest now? Is this it? When is that next bull market, and when do I start investing? And of course, they end up, buying the dip constantly. They end up pushing all their money all in too early, and stocks just keep on falling, right? So that is lost opportunity. They don't have any money left over to invest when stocks fall further. So that's really why I want you to use this strategy of looking for specific points in the stock market for when to invest. Again, those two specific triggers besides those points are the utility bills. When the market realizes consumers aren't going to be there to save the economy because of those high utility bills this winter, and when the market finally realizes a recession is unavoidable, we are going to have a recession, and they start bringing down these estimates for corporate earnings. Again, I'm forecasting that corporate earnings are going to be closer to 200 next year rather than the 243 that Wall Street still expects, and that is going to affect stock prices and stock valuations.